Is P2P lending safe? That's a question you should be asking yourself if you're considering investing your money into peer-to-peer loans. If you are a beginner, you might get impressed by P2P lending sites that offer guarantees and safety nets and other marketing gimmicks to attract new investors. If you are a seasoned P2P investor, you know that those claims don't mean that much and that there is always the risk of losing your money. My name is Jakub from P2P Empire, and in this video, I will explain to you the most common risks that come with P2P lending. The goal of this video is to teach you how you can evaluate those risks and find the platform that fits your risk profile. So there are four main risks that you should be aware of: the platform risk, the lender risk, the borrower risk, and the market risk. I will go over every single risk and give you a few tips on how you can improve the safety of your P2P portfolio. Let's start with the platform risk. The platform risk represents the risk that a P2P lending site will go bankrupt. The main reason for a P2P lending site to declare bankruptcy is usually poor management or fraudulent behavior, which we have seen plenty of this year. It all started with Futsal, followed by Investio, Monetera, and Groupier, which lured investors with high-interest investment opportunities in the business loan sector. The lack of regulations and transparency within the P2P lending industry allow those platforms to build a potential Ponzi scheme without anyone noticing. If you haven't heard about a Ponzi scheme before, here is a short definition. A Ponzi scheme is an investment scam where investors invest money into fake projects while receiving profits from recent investors. This scheme only works if the supply of new investments is higher than the demand for withdrawals. Some of the above-mentioned platforms are already undergoing criminal investigations. The chances of these investigations resulting in the retrieval of investors' money are, however, very slim. So how are the chances that you will end up investing in a fraudulent platform? In 2020, actually quite high. Some companies do an amazing job at disguising themselves as legitimate lending platforms, and many remain in business for years before their fraudulent behavior is identified and they are finally shut down. There are many signs that a P2P lending platform might be a scam, and we have created an in-depth article about how to spot a P2P lending scam, which you can find in our P2P Lending Academy on p2pempire.com. Make sure to subscribe to this channel, as I will also be recording a video just dedicated to P2P scams and how to spot them in the near future. So how can you avoid those platforms? I suggest you read the platform's terms and conditions before you sign up. Look out for red flags like the option to change the terms and conditions at any time without prior notice, or the absence of the clause that states that investors' funds are not the property of the platform. Read about what would happen should the platform go out of business, and do your own due diligence about the platform's employees. Research the CEOs to find out whether they have been involved in any kind of financial fraud or whether they or their relatives have been accused of money laundering. Here's my personal tip when it comes to P2P lending. You should prioritize the safety of your investments over the potential returns. I say potential returns because none of the P2P lending sites can actually guarantee any specific returns. All of the above-mentioned fraudulent platforms offered a high interest of up to 21% per year. So you should be alarmed if the offer sounds too good to be true. While no investor is able to eliminate this risk completely, our P2P lending reviews on P2P Empire will certainly offer useful tips that should help you identify fraudulent platforms. Let's move on to lender risk. P2P investors refer to this also as the risk that the loan originator will default. Loan originators are lending companies that fund their loans through P2P lending marketplaces such as Mintos, Bonster, Peerberry, Viventer, or Ayuvo Group. If you invest on a P2P marketplace, you should conduct research about every lending company that you invest in. Why? Because the P2P marketplace has no skin in the game. It's just a broker that connects you with the lenders. You have probably already experienced what happens if the lender decides not to pay back. Your money will get stuck in pending payments, and you can hope that the interest that you have earned over the years will cover the potential losses. So how big is the chance that a lender will not be able to meet the obligations to repay investors? This risk is very real, as we have already seen a few individual loan originators leaving P2P marketplaces in the past. On Mintos, for example, it's common practice for loan originators to leave the marketplace. In some cases, the lenders pay all of their borrowed money back to the investors, but in other cases, the P2P marketplace has to find a way to retrieve at least part of the loan repayments for the investors. The problem here is that P2P marketplaces, such as Mintos, are not very strong when it comes to retrieving investors' money. If the lender refuses to pay, the P2P marketplace struggles to resolve the situation. We actually see this on a regular basis. Currently, Mintos lender from Poland, Capital Service, refused to repay all of the investors' money back. The chances that Mintos will be able to recover everything are currently quite small, as we have seen similar problems with A40 Finance in the past, which haven't been resolved either. So how can you minimize this risk? This is not an easy question to answer, and there is no way you are able to eliminate the risk completely. In fact, it is much harder to minimize the lender risk than it is to minimize the platform risk itself. Most of the loan originators operate in foreign countries with different laws, different reporting standards, different credit scoring, different debt collection and procedures, and most importantly, different consumers. You as an investor are not always able to evaluate the lender's business model. In some cases, a loan originator will even be part of a bigger financial group. If that's the case, you can most likely at least have a look at their financial reports. There are, however, plenty of loan originators which are private companies that do not publicly list their financial reports. You might also come across old reports or information that isn't translated into English. What you can do is to follow the blog of the P2P marketplaces to spot early signs that a lender might default. Unfortunately, most P2P marketplaces release this type of information when it's too late to change your investment strategy. Let's move on to the borrower risk, which is effectively the risk of default that comes as a result of the borrower being unable to repay their debt. While the majority of borrowers are able to repay their loans, there will always be some that will struggle to do so. Job loss during a financial crisis might be one reason why borrowers are unable to repay their debts. Whether a borrower is able to repay is evaluated by the lender. The lending company conducts risk assessment based on income, expense reports, job position, and further criteria. Most lenders have also a certain level of skin in the game, which means that they invest a percentage of their own money to fund their loans. Some of the loan originators also often have a buyback guarantee, meaning they will repurchase the investor's claims against the borrower as soon as the borrower is late with its payments by more than 60 days. This will, however, only work if the loan originator has enough money to cover for the potential defaults. So how can you minimize this risk? You can minimize borrower risk by investing in different loan types. Consumer and microloans are not the safest to invest in. Those loans are not secured by any collateral, which makes them risky. If you invest your money into loans backed by a mortgage, your investments are secured by a property which will always have some value. A private individual is able to go into bankruptcy, while it is very unlikely that a property will lose all of its value. If you want to keep investing in consumer and microloans, I suggest checking the lender's finances, default rate, recovery rates, and scheme in the game ratios. Note, however, that past performance does not predict future outcomes. Always keep an eye on the announcements from your P2P lending site to be up to date with the latest developments. Let's move on to the last major risk, the market risk. Market risk is an external macroeconomic factor. This risk also includes country risk, currency risk, and political risk. All the above factors might influence the demand for P2P investments as well as the supply of P2P loans. So how much should you pay attention to this risk? During normal market conditions, where the economy is growing, the market risk is not something you as a P2P investor will notice. This, however, doesn't mean that there isn't any. If the global market is hit, many investors will start liquidating their assets, and if a platform isn't strong enough to withstand this pressure, it can default. The market also determines the supply and the demand for P2P loans. If borrowers are not lending money, there are no investment opportunities. On the other hand, if there are too many investors, the interest for P2P loans decreases as the funding gets cheaper. Sometimes this can even cause cash drag. There is also the country risk and currency risk, which influences mainly the financial situation of the lender. If the lender loses its lending license or the value of the currency in which it is lending to borrowers decreases, the lending company might go default, and you as an investor won't be able to recover your investments. So how can you minimize this risk? The best way to minimize market risk is to ensure your portfolio is well diversified across various asset classes. The most successful investors aim to keep 5 to 15% of their investment in P2P lending. The rest is diversified across real estate, stocks, ETFs, cryptocurrencies, or commodities. Another way to diversify your investment portfolio is to invest into yourself or in your business. Often, this type of investment yields the highest returns. Alright, let's summarize this video with 8 actionable tips to improve the safety of your P2P portfolio. The first tip is to read our peer-to-peer lending reviews on P2P Empire with the latest news and offers from popular P2P lending sites. The second tip is to do your own due diligence about every peer-to-peer lending platform. Third, do your own due diligence about individual loan originators. The fourth tip would be to diversify across legitimate P2P platforms, loan types, countries, and loan companies. 5. Don't be greedy. If an offer looks too good to be true, the risk of losing the sum of your investments is too high. Number 6. Invest long-term and avoid impulsive sell-offs on the secondary markets if you don't have a good reason for it. The 7th tip is that you should invest only what you can bear to lose. The 8th tip is to sign up to our newsletter to get the latest time-sensitive news right to your inbox. Those tips should help you improve the safety of your P2P portfolio. As you can see, P2P investments aren't the safest investment type out there. However, the returns can be very attractive if you manage to minimize the risk and keep your investment safe. Let me know how you minimize the risk with P2P lending in the comment section below this video. If you like this video, give it a thumbs up. If you want to see more videos like this in the future, subscribe to this channel to not miss anything. Thanks for watching, and I will catch you in the next video.